Imagine a business doing so phenomenally well that it pulls in um, over $20 billion dollars in just 90 days. But then, in the very same breath, it actively chooses to fire millions of its everyday customers.
I mean, it's wild when you put it like that.
It really is. Today is Tuesday, July 14th, 2026, and Goldman Sachs has just released a second quarter earnings report that honestly proves the smartest money on Wall Street is completely abandoning the average consumer. So welcome to the deep dive.
Thanks for having me. And yeah, it is a remarkable pivot, really hiding in plain sight. Parsing through a global bank's quarterly earnings can usually feel like, wading through an ocean of regulatory jargon.
Oh, absolutely, a dictionary of numbers.
Right. But this specific document is different. We are looking at a fundamental rewiring of how a financial titan actually operates.
And for you, our listener, the mission today is to decode this massive stack of financial documents. Because hiding in these tables and, buried in the footnotes isn't just a story about banking.
No, definitely not.
It's a story about where the global economy is accelerating, where it's stalling, and the eye-watering sums of money being moved around the chessboard right now.
The top line numbers alone just demand attention.
Yeah.
I mean, we're looking at $20.34 billion in net revenues for a single quarter. To put that in perspective, that represents a 39% jump from this exact same time last year.
Wait, 39% for a bank that size?
Exactly. For a mature, highly regulated legacy institution that's constrained by strict capital requirements, a 39% revenue jump isn't just a good quarter. It is a seismic event. CEO David Solomon characterized this momentum in the report as a, quote, flywheel of activity.
A flywheel. I actually love that imagery for a business model. A massive heavy wheel that takes immense energy to get spinning, but once it starts, its own momentum just keeps it accelerating.
It's a perfect metaphor for what they're doing.
But before we get into the actual mechanics of that flywheel, let's remind everyone listening why this matters to them. Whether you're actively trading derivatives or just trying to figure out if you should buy a house this year, Goldman Sachs acts as the ultimate financial barometer.
Right, because how they make their money tells us exactly what the largest corporations and the wealthiest individuals on Earth are anticipating. They are plugged into every major corporate boardroom and sovereign wealth fund on the planet.
So when Goldman's numbers move this aggressively,
It is a direct reflection of structural shifts in the global flow of capital. Absolutely.
Okay, so let's unpack this. Where exactly is this $20.34 billion coming from? Because a 39% jump doesn't just happen organically across the board.
No, it's very targeted.
Right, and if you look at the breakdown, the absolute lion's share comes from their global banking and markets division. This single division pulled in a record $15.52 billion, which is a 53% increase year over year.
And it also represents a 22% sequential growth from just the first quarter of 2026. So the acceleration is actively compounding week by week.
So if Goldman Sachs is a massive, high-end casino, the Global Banking and Markets Division is the high roller room. It's where the velvet ropes are, where the minimum buy-in is like $1 billion, and where the real money is made.
That's a great way to look at it.
But I have to push back a little here. You say it's a strategic masterclass, but I mean, the S&P has been hitting record highs. In a raging bull market, isn't a 53% jump in global banking just the rising tide lifting all boats? Prove to me this is Goldman's doing and not just the broader market dragging them upward.
Well, what's fascinating here is that the underlying drivers have very little to do with simply buying stocks and watching them go up. When you dissect that $15.52 billion, the surge is heavily concentrated in complex financial engineering.
Okay, complex in what way?
Look at equities. That's their stock trading and financing arm. That segment alone surged 72% to a record $7.42 billion. But the report specifically notes this was driven by record net revenues in derivatives and prime financing.
Let's hover on prime financing for a second, because that term gets thrown around a lot. What is the actual mechanism driving that kind of revenue?
Think of prime financing as the operational nervous system for the world's largest hedge funds.
Okay.
When a multi-billion-dollar fund wants to execute a highly complex multi-leg trade, say, shorting a European auto manufacturer while simultaneously going long on an Asian battery supplier, they don't just log into a retail brokerage account.
All right, they can't exactly open up a consumer app for that.
Exactly. They borrow the shares, they secure the leverage, and they route the execution entirely through Goldman Sachs. Right now, institutional investors are facing intense geopolitical volatility and shifting interest rate regimes.
So they need the tools to handle that chaos.
Precisely. To navigate that, They require massive amounts of leverage and customized derivative contracts to hedge their exposure. Goldman is providing that complex plumbing, and they're charging a premium for it.
That makes total sense. So it's not about the direction of the market, it's about the volume of complexity. The more complicated the world gets, the more hedge funds need Goldman's tools to navigate it.
And that complexity extends directly into the boardroom, too. The report notes Goldman holds the #1 position in both announced and completed mergers and acquisitions, as well as equity offerings.
Brokering the biggest corporate marriages on the planet.
Yeah, and this is where David Solomon's flywheel concept shifts from just a buzzword into a mechanical reality. Let's look at how it works in practice.
Let's hear it.
Suppose Goldman Sachs advises a massive pharmaceutical company on a, let's say, $20 billion acquisition of a biotech rival. That generates a massive M&A advisory fee. But the pharmaceutical company doesn't have $20 billion in cash just sitting around. They need to borrow it.
So let me guess. Goldman's debt underwriting team steps in.
Exactly. They step in to issue corporate bonds to fund the purchase, which generates another huge fee.
And if the biotech company happens to be based in Switzerland, now there's a currency mismatch.
Now you're seeing the matrix. So Goldman's fixed income, currency, and commodities desk, the FICC division, steps in to execute multi-billion-dollar currency hedges so the acquiring company isn't exposed to foreign exchange risk.
Wow. So one single handshake in the boardroom triggers this cascading waterfall of highly profitable interconnected transactions.
Across 3 or 4 different departments in the building, yeah?
Yeah.
Once that heavy wheel is moving, the friction just disappears and the revenue compounds.
So the flywheel is generating billions in cash. But a bank can't just leave that cash sitting in a checking account. They have to deploy it, which brings us to the $4 trillion vault, the Asset and Wealth Management Division.
And the vault is overflowing right now. The report highlights their assets under supervision, or AUS, has hit a record $4.04 trillion.
Here's where it gets really interesting. During the single second quarter, just a mere 90-day window, that AUS number increased by $391 billion.
It's a staggering jump.
But I need you to clarify the mechanics of that growth for us. Is that $391 billion mostly just market inflation? Like, the assets they already hold just got more valuable because the stock market went up? Or are people actively handing Goldman Sachs fresh capital?
The report actually provides the exact breakdown to answer that, and the distinction is critical for understanding their real momentum. Market appreciation did account for $161 billion of that increase.
Okay.
But there were also total long-term net inflows of $91 billion.
Ugh.
That is fresh, new capital being handed over by clients. And there's a highly revealing detail buried in the footnotes regarding those inflows.
Which is?
$31 billion came directly from their recent acquisition of Innovator Capital Management.
Oh, I saw that. So they aren't just organically acquiring new clients one by one. They are just buying entire other wealth management firms and bolting those assets onto the Goldman mothership. But why Innovator specifically?
Well, Innovator Capital is a pioneer in what are called defined outcome, or buffer ETFs.
Buffer ETFs.
Yeah.
Okay, what does that mean for the client?
These are highly specialized investment vehicles that allow an investor to participate in the upside of the stock market, up to a certain cap, while strictly limiting their downside losses.
Oh, so it's basically a floor on their losses.
Exactly. By acquiring Innovator, Goldman didn't just buy $31 billion in assets. They bought the proprietary technology and the intellectual property to manufacture downside protection.
Because for the ultra-wealthy clients that Goldman caters to, keeping their money is just as important as growing it.
Capital preservation is paramount. They bought a capability that makes their wealth management platform significantly more attractive to billionaires who just want to lock in their gains.
That is a fascinating strategic play. Speaking of wealthy clients looking for unique vehicles, the report also notes they raised a record $59 billion in third-party alternatives.
Yeah, that number jumped out at me too.
We know alternative investments like private equity and private credit are hot right now, but raising $59 billion in a single quarter is wild. What is Goldman doing differently in the private markets to attract that much capital so fast?
Well, institutional money is moving aggressively away from traditional public markets right now. Public markets are volatile, they're heavily scrutinized, and the returns are increasingly concentrated in just, a few massive tech stocks.
Right. Everyone's chasing the same 5 companies.
Exactly.
Yeah.
So private credit in particular is exploding because regional banks have pulled back on lending due to regulatory pressures. And Goldman is stepping right into that void.
Using their network, I assume.
Yes, using their unparalleled access to corporate data. Remember that M&A dominance we talked about? They use that to price private loans better than anyone else. They can offer a sovereign wealth fund, a bespoke private credit portfolio yielding high single digits with incredibly strong collateral.
And because these are opaque, highly customized private assets, I'm assuming Goldman isn't exactly managing them for a discount.
Oh, definitely not. The management fees on alternative assets are highly lucrative. I mean, you can buy a public stock index fund for virtually zero fees today. But if Goldman engineers a bespoke private credit fund for an institution, they charge a premium management fee, plus performance fees.
And the numbers reflect that.
They do. The report confirms this. Their management and other fees hit an absolute record this quarter, driven directly by these alternative assets.
Okay, so up to this point in the document, Goldman Sachs has the absolute golden touch. The institutional engine is roaring, the wealth management vault is overflowing. But then you flip to the section on their platform solutions division.
Ah, yes, the great retail experiment.
The numbers here are just jarring compared to the rest of the report. Platform Solutions saw its revenue plummet by 64%, all the way down to just $221 million.
Which is incredibly stark.
Against the $15 billion in global banking, $221 million is a rounding error. This feels to me like a Michelin star chef accustomed to charging thousands of dollars for a highly curated tasting menu, deciding to open a drive-through burger joint on the highway.
That's spot on.
They realize dealing with millions of $5 transactions is a completely different game with completely different headaches, and they just shut it down.
The Michelin star analogy captures the operational disconnect perfectly. Platform Solutions was Goldman's attempt to descend from the ivory tower and serve the everyday consumer with checking accounts, personal loans, and most notably, the Apple Card.
Right. And the specific cause of this 64% revenue cratering is clearly detailed in the report, right?
Yeah.
Net markdowns related to the Apple Card loan portfolio.
Yes, consumer credit is a brutal business if you aren't built for it. It requires massive scale, managing millions of customer service interactions, and a totally different approach to default risk.
Which Goldman clearly didn't have the appetite for.
Goldman recognized the structural mismatch. The report notes that this Apple Card portfolio was officially transferred to, quote, held for sale back in the fourth quarter of 2025.
Wait, so by moving the portfolio to held for sale, they essentially cauterized the wound. The losses on those consumer loans are no longer dragging down their forward-looking operating metrics.
If we connect this to the bigger picture, it shows a ruthless approach to risk management. Look at the provision for credit losses. That's the capital a bank legally has to set aside, expecting that some loans will default.
Okay, and what were the numbers there?
For the entire firm, that provision was $102 million this quarter, almost entirely from wholesale corporate loans. But for Platform Solutions, the provision was zero.
Zero, because they've completely washed their hands of the consumer exposure.
Exactly. They took the pain of marking down the portfolio's value previously, and now they're actively severing their ties to the consumer credit space. Consumer loans require a bank to hold a disproportionate amount of capital against them for a relatively thin margin of return.
So it was just bad math for them.
Goldman's leadership looked at the data and realized retail banking was diluting their return on equity and distracting their talent. So they're aggressively cutting the dead weight to focus purely on their highly profitable, core institutional and ultra-wealthy clients.
So what does this all mean for the balance sheet? I mean, the cash is flowing in at record speed, but where is it flowing out?
Well, it takes immense capital to keep the flywheel spinning. The report shows that total operating expenses jumped 26% to $11.67 billion for the quarter.
Wow. While revenues jumped 39%, costs jumped 26%. What is the primary driver of an $11 billion expense bill in 90 days? Is it technology, infrastructure, AI?
No, the primary driver, unequivocally, is compensation and benefits. This is the fundamental law of Wall Street. You eat what you kill. When operating performance improves, compensation expenses rise in tandem. The firm posted a 23.5% return on equity this quarter.
Let's pause on that metric for a second. Why is a 23.5% return on equity so significant?
Because modern global banks are forced by regulators to hold massive bloated buffers of equity capital to prevent another 2008 financial crisis. For most legacy banks, generating a 10 to 12% return on that massive equity base is considered a success.
So double that is huge.
Generating 23.5% requires an astonishing velocity of fee generation. The bankers, the traders, and the wealth managers who engineered those fees, they expect to be paid for that outperformance. Record revenue mandates, record bonuses.
It's the inescapable cost of retaining elite talent. If you don't pay the star trader who just orchestrated a $10 billion hedging strategy, they will walk across the street to a competitor before lunch.
Without a doubt.
But what about the shareholders, the people who actually provide the capital for this whole machine?
The capital being handed back to shareholders is staggering. In this quarter alone, Goldman returned $5.36 billion to common shareholders.
Let's break down how they delivered that, because $4 billion of that total was spent strictly on common share repurchases. They bought back 4.1 million of their own shares in the open market at an average cost of $984.57 a share.
Just massive scale.
Yeah, when a company buys back $4 billion of its own stock at nearly $1,000 a share, that is aggressive capital allocation. They aren't trying to prop up a sagging stock. They are buying at absolute premiums because they believe their internal return on equity will vastly outperform any external acquisition they could make.
It is the ultimate signal of conviction in their own structural momentum. And they reinforce that conviction with the second method of returning capital, the dividend. They announced an 11% increase to their quarterly dividend, bringing it to $5 per share.
An 11% bump to the cash they just hand out every 90 days.
A dividend increase is a sacred long-term commitment in corporate finance. You do not raise a dividend if your forecasting models suggest you might have to cut it during a mild recession next year.
Right, that would be a disaster for their stock price.
It proves leadership believes the structural shifts we discussed, the total dominance in M&A, the surge in prime financing, the scaling of alternative asset management. They believe these are durable, lasting trends, not just a one-quarter blip.
So let's pull all these threads together. What we've seen today is a portrait of a financial titan operating at the absolute peak of its powers. Goldman Sachs has posted blowout Q2 2026 numbers by doing something very simple but incredibly difficult to execute.
They lean hard into what they're best at.
Exactly. They maximize their institutional strengths brokering mega mergers, providing complex derivatives to hedge funds and hoarding wealth for the world's richest clients through bespoke alternative assets.
And just as importantly, they ruthlessly eliminated the friction.
They did. They looked at the Apple Card and the consumer credit space, realized they were playing the wrong game with the wrong margins, and completely walked away.
This raises an important question, though, and it's something I want to leave everyone pondering. This report is undeniably a triumph of corporate strategy for Goldman Sachs. But it also reflects a deeper structural shift in the global economy.
How so?
Think about it. If a financial titan like Goldman Sachs, with all of its technological resources, its infinite capital, and its brilliant quantitative minds, finds it mathematically more profitable and less risky to completely abandon everyday consumer finance in order to focus entirely on billionaires, massive corporations, and elite mega acquisitions.
What does that mean for the future of the financial system?
Exactly. Are we heading toward a permanently two-tiered economy? A world where the most sophisticated elite financial engineering, downside protection, and wealth generation is completely walled off, operating in a velvet-roped VIP room.
While the average retail consumer is left on the outside with standardized, low-margin products.
Right, because this earnings report suggests that for the smartest money on Wall Street, engineering solutions for the everyday consumer is simply no longer worth the effort.
That is a stark reality to confront, and that takes us right back to where we started. When you look at an MRI of the global economy, it's not just about the big top-line numbers. It's about understanding who the system is actively working to protect and who is quietly being ushered out the door. Thank you so much for joining us on this deep dive. Keep looking past the headlines, keep questioning the numbers, and we will see you next time.